so much, Grace. Welcome to UK Prime Time. I believe everybody is doing good. Um, we ready to start Rift before you quit. Today, we are going to dive into episode 7, the psychology trap. Why most traders self-destruct even with good systems. So this is what we are going to, um, uncover today. Most traders don't lose because of bad charts. They lose because human psychology was never designed for leveraged financial markets. Um,
Recording in progress.
if we go back to understand the psychology or the habitability of creatures, I'm not talking about just humans, I'm talking about creatures. Then we basically go back in the history and we look at the instances from history, how history has impacted several habits of humans. I will take an example of pets. Let's say, I'm not trying to compare trading with pets or trading with dogs and cats, but just giving you all a theoretical example of how psychology impacts, how habitability impacts the basis on which people they imbibe new habits and they learn. I'm not talking about just humans but creatures. So dogs have been domesticated for, I believe, more than 400 or 500 years, while at the same time cats have been domesticated from last, I believe, 100 or 200 years. So they are not very human friendly. So that is the reason why when we adopt a dog, when we bring a dog home, they mix with humans better because their inhabitability, their living, uh, their whole species is kind of, their genes are now, um what do you say, compatible with humans to live with. So mostly dogs are the most, friendliest or most friendly animal that lives or that can inhabitate with a human. So similarly, when it comes to trading, whenever we hear the word trade, the first or the original impression of trade word comes to your mind. Uh, it brings a picture of barter. You give and you take. You give something, you get something. So that is essentially barter. So humans have been doing barter from inception when it comes to trading. But trading, when it comes to complex trading with leveraged financial market, is something very new to humans. So human mind is not fully developed or not fully equipped with the leveraged markets, and that is the core reason why we have professional people trading, or we call them traders. That's why it's a different community of people who are professionally trained or who are skilled or learned to do that, to participate and to go on the pitch and play. That's I mean, similarly, if you compare to any sport, not everybody can play basketball, not everybody can play baseball, and few people who can play baseball may not be able to do trading. So similarly, traders or human mind, the human psychology was never designed for leveraged financial markets. It was designed, or it had inherited or imbibed basic trading, that is give and take. That's very fundamental, that we call in a very simple language barter. You give and you take something. In this episode, we are going to go into psychology of trading, how traders self-destruct with even with good systems. In the last 6 episodes, we explored execution structure, capital structure, diversification systems, flow behavior, scalability, automated participation frameworks. But today, we discuss the most dangerous variable in trading, that's human mind. Because even with advanced systems, powerful indicators, AI infrastructure, structured executions, most traders still destroy themselves. Not because of the market defeats them, because their psychology does. The market is designed to attack human emotion. Of course, it is. Financial markets are one of the few environments where fear, greed, hope, panic, and overconfidence are monetized in real time. Market is designed and built to create fear, to enrich greed, then bring hopes and create panic situation. And that's how people, when they make a little, they get overconfident and then they start playing big. So the real market data from Dalbar study says there is investor performance gap. According to the study, long-term investor behavior research over a 20-year-old period, S&P 500 has been giving average annual return of 9 to 10%, whereas average retail investor return is 2 to 3%. Why? Because investors, they panic sell, they chase tops, they revenge trade, they overreact emotionally. While the system or the market, they do not chase that, or a particular professional setup, they do not panic sell, chase stops, revenge trade, or overreact emotionally. The market did not underperform, the human behavior did. So today I'm presenting around from 1990 to 2023 uh, trend of S&P 500 if we compare to the uh, return of average retail investor. And this data is from Dalbar, which is a prestigious organization that records and releases the matrices and scales. So this is market return versus investor return analysis of S&P 500 for the last more than 20 years, from 1990, I think more than 30 years, 1990 to 2023. So, if we look at retail investors, average retail investor return has been consistently at par with 2% because of panic selling, fear of missing out, emotional entries, and revenge trading. We are going to go inside revenge trading in detail today. The single biggest enemy of investment performance isn't the market, is the investor, says Salvar. This is one of the most important charts in finance. The market often performs better than the participants inside it. And that's why S&P 500 as a stock has been profitable 9 to 10% every single year for the last 20 years. Why profits make traders more dangerous? Most people think losing creates danger. In reality, early profits are often more destructive than early losses. Whenever you make a little more, little extra, or you know, a little higher profit in beginning, you get overconfident, and that's where everything gets becomes south. So the psychology loop. Typical retail progression is the same chart that we discussed. Small early wins, overconfidence develops, then position sizes increase, then risk discipline disappears, and emotional aggression increases, which leads to large drawdown. And the moment large drawdowns occur, then revenge trading starts. Let's take real market example. Dogecoin mania in 2021, when millions of new traders entered into the space. They entered after social media hype, they made fast profits, They believed volatility is skill, but actually the market gave them the answer later when momentum reversed. The accounts they collapsed rapidly, over leveraged position failed, emotional exits accelerated losses. Temporary success often creates permanent bad habits. So the overconfidence cycle is something that we are going to pay attention today. Small wins, they bring a little more confidence, and that in your brain brings dopamine spike, which gives you feeling of more confidently placing positions and risk taking ability. Then you go on and take larger risk, and the moment you take larger risk, you make bigger positions, you get into stress because you see your Bitcoin position 2% down and you are at, let's say, 30x leverage. And that's when your cortisol level they start to increase and you get into real stress. And then the judgment or the impulsivity increases. The moment you get into stressful situation because of ongoing position or ongoing positions that you have, then you get involved into emotional trading as well. So from the larger risk part, the emotional trading begins because your brain has developed more or has started to um produce more cortisol in the body, that takes you into emotional trading journey or cycle. And when you start emotional trading, then you develop a feeling of selling some assets which you have. That is the panic condition in which you fight or flight emotion is developed when you lose control and you trigger exit. You try to sell some position to gain a little bit or to reduce the loss, and then you stay constantly in panic. And when you are panicked, you start revenge trading to recover the loss, to recover the drawdown that you have got, or you start feeling more in that position to not to lose that position. Then revenge trading starts, of which emotional response comes, and you seek to win back losses with more risk. So you start taking maybe you open one more position at in a different trading account. At If you are sitting on long, then you open a short position at the same time to make sure that if you lose in this position that you are winning on the other, so your loss is kind of balanced. But this balance never happens. This equilibrium is never achieved by you as a trader, as a retail trader, or any professional trader, I would say. This overconfidence cycle, and post this recovery attempt, the trader dies or the account it gets blown. So, and then the cycle repeats. Again, dopamine spikes, and you all know, I believe, how dopamine rush it affects your body. It affects your. It's a psychological thing. It's a altogether a study that is done on traders, on minds of traders. It's a psychological loop that drives trading outcomes. So ego inflates, risk escalates, discipline disappears, and cycle repeats. So discipline breaks the loop and awareness builds freedom. At Rift, especially in auto training engine, we never let you get inside this loop or this life cycle of emotions, because you stay consistent in a disciplined execution every single day. Your capital uh, uh, comes back, goes in at the same point from a self custodial point and comes back to your self custodial point, and that's where it keeps on going and coming to you in a disciplined, in a well structured manner. That's why you never fall into this life cycle of psychological, or you don't even get dopamine rush because you don't have ability to sort or filter. The moment we had given you the ability to sort or filter or to select or choose positions, then this dilemma would have started to come inside you. And so right now, the learning from this overconfidence cycle is the awareness that brings discipline, and discipline brings control. Even if you trade manually, you break this cycle and protect your capital. Capital preservation is one of the smartest ways, one of the uh, most sustainable route towards making consistent returns, consistent profits for a long, long period of time. So the dopamine problem in trading, let's go in detail. Trading affects the brain chemically. This is not motivation, this is neuroscience. Real science data says the research finding shows that winning trades trigger dopamine release. Dopamine creates reward reinforcement, and traders begin chasing emotional stimulation instead of structured execution. This is why many traders overtrade after wins, increase leverage irrationally, and cannot stop trading during volatility. That's heavily dependent on the dopamine that is released in your brain. The brain starts seeking excitement instead of efficiency. Let's take a real example. Crypto futures traders during high volatility. During Bitcoin, volatility spikes, trading frequency rises sharply. Leverage usage increasingly increases dramatically. Emotional decision making intensifies. Many users become addicted to market stimulation itself. They love it when the Bitcoin goes up and down because that's very fertile time to make a lot of money. And then let's go into revenge trading mechanism. Before we start revenge trading mechanism, I'll like to take a break. 1 minute, I'm getting a call.
This has been very, very informing, very illuminating thus far. Is the whole entire psychology, this whole overconfidence, um, look, the look at the overconfidence wheel of how that stimulates you or causes you to really think that you cannot lose. And I think it's called, and then the dopamine high is called the gambler's high. So this is just amazing. And just what are you thinking so far, Rajiv? Can you relate with me?
Yes, absolutely, absolutely. This is exactly what happens, and I'm sure everyone who is present here has gone through this. These are the emotions that everyone goes through.
Exactly, exactly. So thank you, Chavez. So far, you have confirmed everything that I know that I've been doing. So thank you, appreciate it.
Okay, shall we start?
Yes, please continue.
Okay, so let's get into deep into revenge trading mechanics. One of the most destructive behaviors in trading is revenge execution. After a loss, brain seeks emotional recovery, not strategic recovery. The objective becomes getting the money back instead of protecting the structure. And we have data as well. The if you are trading at a normal position that is stable, balance, and control, and all of a sudden there's a loss event that comes. The moment this loss event comes, let's say your PNL impacts a little bit, maybe 2%, maybe 3%, maybe 1%, maybe 0.2%. And then your emotional stress spikes. You tend to cover that loss with another trade, or you start to think of adding some more funds to the existing position to dissipate the loss or to open another position. Like I said, in a different platform at short, if you are going long, if you are going short, then you open a long. So emotional stress spikes and you increase the position or open another one, and then you face a rapid drawdown somewhere, either in the long, either in the short. And that's always something that happens. That is the reality. We cannot, that has happened to all of us, even me, you, everybody who is listening, who will listen. And that's where the capital collapses and we just get, I don't want to use the F word, but yeah, we just get blown away. So, stress, discipline, risk. And believe me, if you, um, I mean, if you don't believe me, then wear a heart rate monitor. If you all wear a Apple Watch, then look at your heart rate when you open a position, and when it goes up, look at your heart rate. uh, when it goes down, take the readings with yourself. You will understand that this is real. The whole profitability, it impacts your brain, because your brain, before money, it seeks emotional recovery, or it seeks for, you know you want to basically prove yourself right. You currently sit as a trader that has power to open another position against the market, and market is always moving, or will always move against your whims and fancies. It won't move according to your perception or your fancies. So the market doesn't punish the bad ideas, it punishes poor behavior. Behavior is bigger than the strategy, and discipline is bigger than intelligence, and survival is bigger than ego. Uh, and these three things are, I believe, most important factors when it comes to a point where you face a loss, small loss, and that's where you try to rush for. I mean, the same thing when you lie, when you tell somebody a lie, a small one, then you have to lie like 10 to 15 more times to cover that up. Same thing happens in trading. When you face a little loss, then you try to cover that up with bigger F words. So I don't want to, yeah, I believe you guys understand. So you guys get into that. Um, and whereas if we compare to the institutional principles, it is protecting the capital first. Emotions are, I mean, understanding that emotions are the real opponent, not markets, and size for survival, not for glory. Means whenever you have a position, you either go with the market or you stay consistent with it and wait for the market to react. You don't increase or you don't open another one just for the sake of with the revenge trading exposure, or do not let your behavior or emotion or heart decide what to do, not for the glory. And discipline is the edge. uh, the new edge, as we have been talking for the last six episodes, is not time, is not signals, it's time, it's execution, it's strategy, it's discipline. So, overall, if we talk in nutshell, discipline is the edge, and risk what you can afford to lose. And that is, I think, one of the smartest and one of the most uh, fundamental practices that every retail trader should follow. If you're not a professional trader, you don't do this for your bread and butter, then you should only risk what you can afford to lose. Let's look at real market data. Binance future retail statistics show large percentages of retail futures traders increase size after losses, average down emotionally, and over leverage during recovery attempts. And this dramatically accelerates liquidation risk. The market punishes emotional urgency because you rush when you're not supposed to rush. Why most people cannot handle volatility? Most people believe that they can tolerate volatility until real capital fluctuations they begin. For example, Bitcoin drawdowns. This is the most important subject of today. The Bitcoin historic drawdowns, 30%, 50%, over 80% drawdowns have been faced by Bitcoin. So yet long-term adoption and continued expanding helped Bitcoin to compound consistently. The problem was not volatility, the problem was emotional tolerance. Whenever Bitcoin drawed down, people started to panic sell. I'm not talking about leveraged traders, I'm talking about holders also. The problem was never emotional tolerance. And if we look at the chart of Bitcoin from 2011 to 26, we see Bitcoin crash in 2018, 84% drawdown. During COVID, it crashed 50%. In the 22 bear market, it crashed 77%. But at this point, Bitcoin is still $80,000 today, because of the long term growth and consistency that Bitcoin has um, continued to follow. Volatility is temporary, but adoption, that is accelerating, whereas Bitcoin has a scarcity mechanism which plays a long term trend that remains intact. But during these crashes, during these volatility uh, positions, people lost a lot of money. People lost their lifetime savings, lifetime earnings, and that is that these crashes have been the craziest crashes in the history. So past performance is never the indicative of future results. This is also something that we need to understand. But and some, I mean, we all hear and listen to traders, professional traders, when they sit and look at the candles, they draw a line and then they tell you, hey, the Bitcoin is going to bounce back after the moment it touches $70,000, it's going to bounce back. That's all bullshit. So whatever these people, these traders, these gurus, these experts, they tell you, that's all crap. Market does not move according to mathematics, according to the uh, past performance that it has shown in the chart. It moves according to the trend that happens, according to the volatility mechanism, according to the liquidity, according to the supply and demand. It does not move in the according to the fancies of a trader or a guru. So most retail traders buy emotionally during euphoria and sell emotionally during fear. That's where people get their wallets empty when the times are very emotional and they are in fear. Professional systems operate inversely. Why structured systems matter? This is where structured systems become critical because systems do not panic, they do not seek revenge, they do not become euphoric, they do not chase dopamine. System operate through the rules, humans operate through emotion. Now let's connect it with Rift Auto Trading Engine. Rift architecture reduces impulsive execution, emotional overreaction, random participation behavior. Through structured flows, allocation systems, participation architecture, automated execution environments. And if we look at, if we compare it to human execution over trading, then we can relate it with Rift. When you place an order, when the capital goes to the engine, it gets into flow classification. Gets allocated into three different flows, and at the allocation engine, it gets into different venues where the trading layer determines the first it receives a signal, then it does risk and compliance check, then the smart order construction is done and the order is placed, then the order is routed, the dynamic routing is done, and execution monitoring is done, and the trade is closed. And after the trade is closed is post trade analytics, in which the PNL is designed, is profit bounces back to you. This is high quality execution which is consistent and measurable. And if we compare, if we put Rift auto trading engine in the stable participation curve and compare it to a professional trader, it shows it has low impact, high fill rate, consistent results, disciplined process, scalable advantage. Why? Because it never stops, it repeats, and it does it in a disciplined, in a structured execution. Discipline, architecture, advantage. Execution isn't luck, it's design. So now let's look at compounding. So, compounding destroyer. Compounding requires consistency. Emotion destroys consistency. Sometimes, let's take a real example. A trader making 5% consistently for 12 months often outperforms a trader making 100% once and collapsing afterward. The market rewards survival longer than aggression. The survivability or capital preservation, that these terms should be in our heads always when we talk about the futuristic trend in which we see trading, we see automated trading engine and the whole Rift architecture. Why professionals think differently? Retail traders, they chase excitement, predictions, massive wins. Professional systems prioritize longevity, stability, repeatability, survivability. The real market example, the Renaissance technology or quant funds. Top quantitative funds firms focus heavily on risk adjusted consistency, statistical edge, execution discipline, controlled exposure, not emotional prediction. The future of human trading. If these are all the emotional challenges in the trading, what would be the future? The market structure itself is evolving. Algorithmic systems now dominate equities, futures, forex, crypto, liquidity environments. Human emotional execution continues becoming less competitive in the whole market. If we look at US equity market, over 70% of the US equity market now involves algorithmic execution influence. This means Market increasingly rewards structure, speed, and systematic behavior. The real enemy. The real enemy in trading is rarely the chart, market, or the system. The real enemy is undisciplined human behavior under pressure. Um, I think this should be your phone wallpaper while you use trading apps or you take leverage. Most traders are not defeated by the market, they are defeated by fear, greed, impatience, emotional inconsistency. And the future belongs to structured systems, disciplined execution, stable participation architecture. And the people who survive emotionally long enough to compound structurally. So, in the next episode, we are going to get into the future of AI driven market participation, how intelligent infrastructure is replacing traditional trading. Next topics will be AI execution systems, machine learning in market behavior, predictive infrastructure, the prediction layer that we are building over the swipes that you make in the cards, the institutional automation, future of quant participation, why manual trading is declining, AI versus discretionary execution. Thank you so much for joining episode 7. I'll see you all on Monday in the episode 8.